Hello and welcome to this podcast. This is Professor David Lopez, and today we're going to discuss at a very high level choosing an entity for startups and entrepreneurs. This program will cover various choices as well as some important distinctions. So let's get started. First of all, an entrepreneur cannot choose an entity in a vacuum. There are a number of different questions to consider as you go through the process to decide which entity is appropriate for your startup. First of all, what is limited liability protection? What are you protecting from? Limited liability protection separates the assets of a business from the personal assets of the owner. One of the questions to ask is, how risky is the business activity? From a regulatory perspective, legally, environmentally, and even politically. Another question is, who is going to own the business? Whether it's an individual, a family, investors, or a management team, that'll have an impact on the best strategy to utilize. How will the business be financed? Will it be bootstrapped, lending activity from a bank, or other investors? Is this a hobby business? Is it a very small business? If so, you're going to have some limited choices there. What happens when, and you notice I say when, the company becomes profitable? How are profits shared and distributed? Are they distributed through dividends? Are they reinvested in the business? Will owners get a draw or some type of salary? What's the long-term view of the business? What are some of the exit strategies that you as an entrepreneur are considering for the future? Will it be an IPO? Will it be part of your estate? Will you dissolve it after you pass on? Or will you potentially sell it to a larger company or competitor? Keep in mind the costs when you decide what entity to choose. There are legal, state fees, licensing fees, and permits as well. Will you be hiring employees or independent contractors? That's another important question. Now, as you go through the process of determining which liability entity is right for you, keep in mind that limited liability can be lost, and there are a number of different ways it can be lost. If you commingle funds, personal funds as well as business funds, that can break the veil of limited liability. If you misrepresent your product, if you don't maintain good records, you don't pay payroll, if you do anything illegal, the limited liability will disappear. So let's take a look at some of the popular business choices that are available for entrepreneurs. We will be traveling from unlimited liability choices to limited liability choices, then reviewing all the choices and drilling down on each one. Let's start with the unlimited liability choices. The two we're going to cover today will be sole proprietorships and general partnerships. The sole proprietorships generally mean that the personal assets of the owner are at risk to creditors and other people that are planning to sue, perhaps. General partnerships are very risky because one partner can bind all of the other partners by his or her own actions. It's difficult to transfer business interest, difficult to raise capital, and certainly hard to resolve disputes. Moving toward the unlimited to limited liability choice, the next one is limited partnerships. In a limited partnership, generally speaking, you have a general partner who is assuming all the liability and the profits, and a group of limited partners that would be considered passive investors. Examples of limited partnerships would be oil and gas, real estate, and film. Let's move on to the limited liability choices. These choices include corporations, S-corps, professional corporations, limited liability entities, also known as limited liability companies, partnerships, or professional partnerships, they limit the liability to the value of the investment. One of the main differences here also between the other choices we've covered would be the tax treatment. Keep in mind that the assets of the company are always at risk. Now let's take a closer look at each one. Sole proprietorships and partnerships are very common. Sole proprietorships are really the most common because they're relatively easy and inexpensive to set up. On the darker side, there's an unlimited liability because basically the business is considered the same as the owner from an ownership and tax perspective. Sole proprietorships and partnerships end when the owner or the partner dies. Company and owner are interchangeable, which makes it very difficult to raise capital. Again, easy to organize, ease of management and record keeping, single taxation. Any profit flows directly to the owner or the partner. That's why these choices are very common. On the other side would be corporations. Some of the advantages of a traditional corporation or a C Corp would be limited liability for all shareholders, unlimited number of shareholders with no ownership restrictions, and may have more than one class of stock. Some of the disadvantages on the C Corp would be it's more complex to form and maintain. Filing with the state is required. There's an issue of double taxation, and there's a requirement for an annual meeting. A corporation, unlike a sole proprietorship, does have a perpetual life. Moving on to the S Corp. The S Corp has a perpetual life as well, and it's also separate and distinct from owners. Some of the advantages for the S Corp would be limited liability, again, for all shareholders, pass-through tax treatment, and generally speaking, annual meetings are not required for an S Corp. Some of the issues or disadvantages with an S Corp would be there perhaps could be ownership restrictions, only one class of stock, and it's much more complex to form and maintain, again, over a sole proprietorship. Let's move on to limited liability entities. They still have the limited liability. They look very much like a partnership. They're separate and distinct from owners. Still can be difficult to raise capital, more difficult, of course, than a corporation. Some of the advantages to the limited liability entity choice would be limited liability, again, for all members, and again, members, pass-through taxation, unlimited number of members, and no limitation on who or what type of entity may be members. In terms of some disadvantages, usually have to file with the state, and there are more formal formation requirements. Lastly, let's take a look at the differences or some differences between bylaws and operating agreements. First of all, bylaws are used for corporations, where operating agreements are used for LLCs. With the bylaws, they include the principal office as well as the name of the registered agent. Bylaws also describe the types and classes of stock available, preferred or common. And again, bylaws generally describe the powers and duties of directors, whereas operating agreements describe general powers and duties of managers. Also, operating agreements include initial capital contributions and percentage of interest for each member. This concludes this podcast. This has been Professor David Lopez, and I hope you have a nice day, and thank you for listening.